Japan was once the world's rising star. In the 1980s, it was outcompeting the US in cars, chips, and exports. But then, everything changed. Japan slowed, then stayed stuck. Now, it's showing signs of life again, but its story may be repeating in unexpected places. In the early 1980s, Japan ran huge trade surpluses, especially with the US. America responded with pressure. In 1985, the Plaza Accord forced Japan to strengthen the yen. Exports dropped fast. Japan loosened credit to stay afloat. The result? A massive asset bubble. And when it burst, Japan entered its lost decades. Japan didn't crash. It stalled. Wages flatlined. Growth slowed. Corporate investment stayed cautious. And policymakers never broke the cycle. Today, inflation is back. The central bank is tightening. Profits are at record highs. But GDP still barely moving. This isn't just about aging. Japan's workforce is growing again, with more women, seniors, and foreign workers. The real issue? No one believes in long-term demand. Firms don't invest. And now, even bond investors are signaling doubt. Japan's most recent 40-year bond auction saw one of its weakest demand levels in years. Even with inflation and yield, the market didn't want long duration. We actually covered this auction in detail and how it shook global markets, including the US. Watch the full breakdown in our video. Japan's bond auction failed, and it shook US markets. The link's in the description below. After Japan slowed, another export giant rose, China. It followed a similar model. High savings, state-led investment, massive trade surpluses, and export dominance. And now, just like Japan in the 1980s, it's facing heavy pushback from the US. But China is not Japan. Here's what makes China fundamentally different. China's economy is nearly 10 times larger than Japan's was at its peak. It now spends more on research and development than the EU. It has broad access to markets outside the West, from Russia to Southeast Asia to Africa. It retains capital controls, allowing more control over inflows and outflows. And its political system enables rapid policy shifts that Japan's democracy could never match. Yes, it faces real risks, property stress, and youth unemployment. But it also holds tools and leverage that Japan never had. The question isn't will China become Japan, it's whether it can avoid that fate or evolve beyond it. In the 1980s, the US pressured Japan. In 2025, it's pressuring China with tariffs, tech bans, and decoupling. But unlike the 1980s, the US now has problems of its own. Debt is high, growth is slowing, and political dysfunction is rising. Despite 30-year yields approaching 5%, demand is weak. Big firms like DoubleLine, PIMCO, and TCW are backing away, not because the returns aren't there, but because the future is too uncertain. Investors are now favoring shorter duration treasuries, like the 5-year, over the 30-year. That preference shows up in the yield curve. The spread between 30-year and 5-year treasuries has climbed above 1 percentage point, a rare divergence. The further out you go, the less investors trust the system. This isn't just about rates or inflation. It's about belief in growth, in leadership, in the future. Japan lost that belief. China is fighting to hold on to it. And the US, once the anchor of global trust, is showing signs of strain. When bond markets pull back, even at 5%, they're not just avoiding risk. They're saying, we're no longer sure this system will hold up. So we're left asking, is this just a new chapter? Or are we watching Japan's story, now playing out on a global scale? We cover stories like this every week, where economics, history, and policy collide. If you found this useful, give it a like, drop a comment, and share your take. And if you want to stay ahead of the narrative, don't forget to subscribe. Japan's story isn't just history. It's a mirror, and this time, more than one country might be staring into it. Thanks for watching, and stay tuned for more stories that actually matter.